As a founder, should you bootstrap your business or raise venture capital? Hi, I'm Mike Lyon, founder and managing director at Vista Point Advisors. In this video, I'll discuss these two approaches, how they differ, and their relative strengths and weaknesses. In general, bootstrapping means raising as little capital as possible to grow the business versus the multi-round funding strategy VC-backed businesses employ. I would consider the following key factors when determining which path is best for your business. Control. How important is controlling the decision-making process? If you value control, the VC route will invariably lead to a loss of majority control and significant friction with investors. Risk. How much risk are you willing to take? VCs generally ratchet up the risk profile. Their portfolio approach leads to risk-seeking behavior. They either get a home run or a zero. Some founders are aligned with this behavior, but many are not. Size of the outcome. How big can the pie reasonably get? By raising VC, you'll end up owning a slim piece of the final outcome. If you can't get $1 billion plus outcome, it is unlikely you will do better in the end by raising a lot of capital. Owning a larger piece of a smaller outcome will likely be better. Competitive landscape. Is it necessary to raise capital to compete in the market? This is more likely the case in horizontal software applications like CRM versus vertically oriented software markets like real estate, education, or field services. In general, the larger the TAM, the larger the number of well-funded competitors. A founder should consider the VC path in situations where the market opportunity is massive, like Salesforce massive, innovation costs are high, the market is highly competitive and product differentiation is difficult, and network effects are key to success and require speed to market. A founder should consider the bootstrapping path in situations where you're in a vertical software market, you've reached scale and are still growing, your business model has high margins, you want to maintain control, and your TAM is on the smaller side, less than about $1 billion. An alternative approach to the VC model is to grow the business until about 10 million in ARR. At this scale, you can do a growth equity deal that nets a large amount of liquidity and find a partner that may be more aligned with your risk profile. For more details on these two paths, please take a look at the article our team put together on this topic, or feel free to reach out to one of our bankers at Vista Point. We're happy to help.